Chapter 5 exam after class. It'll be due a week from it's doing Halloween. And we should be able to finish the sampling overviews too. If we get through this, I'll be thrilled. I think we should be able to do it though. Okay, let's hop into do something here. Let me save that. All right, evidence. Second. I'm sorry, I'm going to try to turn off my. You know what's irritating about this phone? I got a phone that you can't turn off the notifications for the phone. You can't see that. It's grayed out. So, well, and the only way you can do it is by putting it in airplane mode, which, takes out all the Wi-Fi and bricks your phone. So anyway, those are my problems that are unrelated. Blah, 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 blah. Down here. I think there's a couple things I left off here, I think. I know there's at least one thing I left off. Okay, this I didn't put on here. Let's go to number 9, the management representation letter. And I know I said stop here. I want you to add this to it. The management representation letter, the management letter they usually call it, it's not used in place of evidence. It's not standalone evidence. It's only used to corroborate other evidence you already have. So, for instance, you may have a client that says, look, we're going to sign that letter. Do we really need to do all this testing? We're going to sign the letter. We're not going to balk on the letter. We're going to sign it. You don't have to do all this expensive testing on stuff. It doesn't replace evidence. It simply corroborates it. So, and two is to make sure that you have the information that they gave you, that you have it correct. So they can look at it and say, well, wait a minute, what's this? And if maybe there's some miscommunication, it also will be rectified before the audit is over. Okay. One of the main things we do is external confirmations, and we talked a little bit about this last time, and that is we try to move evidence up the ladder. If the bank sends a bank statement to the client, we tell the bank to send the bank statement to us. That moves it up to the best evidence because it goes directly to us. The client doesn't have any way of getting to it. So confirmation, external confirmations. Usually when they're talking about confirmations, they're talking about accounts receivable. And there is a split in the rules here for international and US standards. Do this. Hey, okay. US standards, they are required. International standards are not required. So accounts receivable confirmations, if they have accounts receivable, confirmations are required. International standards, they are not required. Now, I think I mentioned this before. If any of the audit is done in the United States, you have to follow the U.S. rules, and the U.S. rules are that it's required. So if it's an international audit and any part of the audit is in the United States, they have to you have to confirm accounts receivable. Accounts receivable comes about from the risk of a client simply making up, sales orders? What's to stop them from, hey, we need more sales. Okay, let's print out a sales order. Now, if they print out a sales order, make up a client, or even if they make up a sales order and send it to a client or a customer, I should say, of theirs. So they print up a sales order, send it to one of their customers, or make up a customer. The problem is it's not going to get collected. It's fictitious, it isn't going to do it. So what's going to keep a client, your client, the company you're auditing, what's going to keep them from doing that? Well, accounts receivable confirmation. You have to look up, go through and do confirmations for their accounts receivable, and you send out confirmation letters to them saying, hey, our client, let's say IBM says that you owe them $12,000. Is this correct? As of 12/31, whenever. Is this correct? Yes or no? If no, then tell us what's wrong about it. So um, a confirmation is really moving it up from simply the documents that the client has to making it much better evidence, and that's you're getting something right back from the client, scratch that, their customer, IBM's customer, which would say, give you some more information on whether this is the correct amount or not. And again, it's coming from a third party. Like if you're auditing IBM, it's coming from their customer saying whether this accounts receivable that they have is valid or not. But it's very important, to do this. And U.S. standards say it's so important that you are required to do it. International standards say if there's other ways of getting, the just as happy about it, you can. But again, if any of the audits done in the United States, you have to do the confirmations. You have to follow the U.S. rules. And by the way, I think I'd mentioned this last time. There really aren't any conflicts between the U.S. rules and the international rules when it comes to auditing, but they're at different degrees. So there's nothing to say for the international standards that you can't do the confirmations. In fact, many, if not most of them, I'm sure do, but it's not required. You can do them though, and not be in violation of the international standards. They don't say you can't do them. They just say that it's not required. It's optional. It's up to the auditor to make that judgment. Okay, so confirmations. They come in two different forms. Negative confirmations are the confirmation is returned only if there's a problem with the account. I think I took off I did. So negative confirmations. The confirmation is returned only if there's a problem with the account. And they'll have verbiage to this saying, if so, they say if there's a problem, send it back. So please let you know. There isn't a problem. Please disregard this request. How do you spell disregard? Where's my spell check? Yeah. My wife would be so proud. You spelled it right. So, and so this one they explain what the problem was. If there isn't a problem, they say disregard this request, and they wouldn't send anything back. Positive confirmations. Positive confirmations are all of them must be returned. Oops. Yeah. And so it'll say something along the lines of, please return the envelope. Something along those lines. But all confirmations must return. Please return the envelope provided, and you must get all these. All these must be returned. So negative are only if there's a problem, and positive are we want them all back. Whether they're correct, incorrect, whatever, we want them all back. Okay. I think I'm going to hold off on the next thing. Well, no, I guess I got to talk about it now. Which one of these do you think is better? Which is better evidence? The negative confirmation saying only return these if there's a problem, or the positive one saying we have to get all of them back? Which ones are probably better? Give better evidence. Let's say more complete evidence. Anyone? Oh, come on, flip a coin. Be wrong ones. Oops. Which one do you think of these do you think is better? No one? All right. Looking at an oil painting. Um, all right, let's go ahead. The positive ones are better. The positive ones are better because you don't know what happened with the negative ones. Someone may get the negative one and go, what's this, and just throw it in the garbage. What? They look at it. This is wrong. They're idiots and throw it in the garbage. It doesn't get returned. So you don't. For the negative ones, you actually don't really know. You can't make any assumption on the ones that were not returned. You can only look at the ones that were. So only the ones that were returned are the ones that you need to look at. And that's the only evidence you're going to get. So you really don't know why they didn't return it. It could be that it was lost in the mail. They never got it. It could be that it was sent to the wrong address. It could be that, whatever. So the negative ones are generally not as good as the positive ones. Now, the positive ones are better, but they are also kind of a pain. And they're a pain because you have to, if you send out 100 of them, you got to get 100 of them back. So you send out 100 of them, you get 87 back. Okay, so you're missing what, 13? You send out 13 more, you get 4 of them back. Okay, so now we're up to like 91. All right, so then you call people up and, oh, yeah, yeah, I got it right here. Somebody says, oh, yeah, I meant to do that. Okay, yeah, yeah, let me look at this. Okay, yeah, I'll send it back. You get that. And then, finally you get down to the last 2 or 3 and you say, okay, do you have a fax machine? Yeah, no, well, while on the phone here, I want you to fax it over and oh, here it comes. Okay. You have to hunt them down. You have to get all of them. All hunt. So, yeah, they can be a lot more work, but it's better evidence. Now, you say, okay, well, what, if it's better evidence, why do we have the negative ones? And there's a couple of reasons why. Okay. Um, the first idea is this down here. Which type of confirmation should the auditors use? And they have a choice. Down here, they could use the negative ones, or they could use the positive ones. And they'll be just as happy. They'll be equally satisfied, I guess is the way I put it here. They'll be equally satisfied either way. So they'll be equally satisfied if they get 100 negative confirmations or 100 positive. Now, negative ones aren't as good, so they need a lot more to get happy or satisfied, I guess. And the positive ones, they need less because this is better evidence. If you're doing an audit, which one would you choose? There's definitely a better choice here. So which one is it? I'm not sure if I'm going to listen here. Okay, well, see what the total cost is. Now, if you're equally happy, you're going to want to go with the negative confirmations. It's cheaper. And it's not just cheaper for you, it's cheaper for your client because you have less billing on them. Okay, now there are types of accounts though that are generally used for the negative and types that are used for the positive. And the types of accounts that we use for the negative are when we have many of them and low values. So these are the type of accounts that we're going to use for the negative confirmation. And the idea is even if they you don't get some of them back, they get low values and it's probably not going to be material anyways. Positive confirmations, just the opposite. If there are few accounts and high values. So positive confirmations, so negative confirmation. Let's do this a little differently. Let's do this. We'll color coordinate these. And it goes, if they're high values, you have to get them back. Because any one of them might be material. Okay, so those are confirmations. And I'm probably getting my spacing off here, but I think we talked about this. I can't remember. Working papers. Oop. You to plan the audit, document findings, and truthfully, in the end, to support their opinion. Oops. So it's used for a few different things, but the most important of those is that you want to support the auditor's opinion. It's used to plan the audit. They're used to plan the audit. They're document the findings and all that, but they're also there to support the auditor's opinion on the audit report. So these are for the auditor. They're not there for evidence on the financial statements or anything like that. The client, IBM should have those. Okay, the auditors own the work papers. The client does not. The client does not have the right to view the work papers. The client might say, well, wait a minute, I paid for all this. I want to see what you guys did. They don't have the right to view the work papers, and you would never give them, the opportunity just to go through them. And for good reasons. For instance, you wouldn't want the client to know what you consider material. If you say, 80,000 is our materiality, well, then they'll know, okay, we can go up to 70,000 on this. You don't want them to know things like that. There are also stuff that could be confidential in there. Maybe they got a tip that somebody was committing a fraud or something like that. You go and you investigate it. There's nothing there. You don't want that to get out. You don't want that to, someone's reputation being, smeared for no reason. I mean, so there are things that are in there that while you document them, everything you find, you document, they're not necessarily for anyone other than the auditors, even the client. They say, well, we paid for this. Like, yeah, you paid for us to give you an opinion, and we're going to give you an opinion on the audit report. So, you don't let them see it. Now, the times that you might let them see at least part of it is if you come up with a problem. They say, you say, okay, we found these 5 accounts receivable were off, but they're not material or something like that. They might still want them. They might say, well, can you just give us those? Because I want to see, just to improve our system, so it isn't that you necessarily won't give them the documentation, but they have no right to it. And also, you're going to pick and choose what you give them. You're not just going to say, oh, here they are, here's all the work papers, go, take a look at them. So you're going to pick and choose what they actually can see. And again, you will, if they're trying to make improvements, obviously, with the company, with reporting, you're going to probably want them to do that. So there are some things you might share with them, but they have no built-in right to it. They're paying for the audit opinion, not for the work papers. I feel like we've talked about this. Am I repeating stuff? Maybe not. Confidential nature of the work papers. The auditors own the work papers. I think work papers is one word. Oh, not spelled like that, it's not. They're on the work papers. However, the auditors have a fiduciary duty. Oop, there should be a U. Okay, clean this up. Oops, let me try actually cleaning it up. Okay. Confidential nature of the work papers. However, the auditor have fiduciary duty not to share the client's confidential information. And generally, um, will only comply with valid Actually, that's not the way to spell that. Okay. Oh, I mixed up the E and the O. Okay. That's why I didn't go to law school. So they have to get a valid subpoena, approved by a judge. There are some states where even that won't get you in the door. In some states, it's almost like a lawyer confidentiality, where you don't share anything. That the courts don't have a right to know um, what goes on between for instance, a criminal law or just a regular civil law with between the lawyer and the client. They can't break into that confidential um, confidentiality. And in some states, I don't think there's too many, but in some states they say even a subpoena you can't, they don't have to comply with. But in most of the time, in most states, you're going to have to comply with a subpoena. But only a subpoena. It isn't somebody looking for information, a lawyer letter, or a you know government agency or IRS. If any of those people, if any of those groups need information, they have to go get a subpoena. They have to convince a judge that it's necessary enough that they get it, that they'll actually get a valid subpoena to do it. So you don't comply with anything other than a valid subpoena. Okay, retention of the working papers. Yeah, CPA, the guidelines are for 5 years. Now, in the AICPA, they only give guidelines on it because they're not a government agency, but usually the states will also adopt it, and the states might adopt 5 years. They may even adopt more than that. PCAOB are 7 years. This is kind of the Enron rule. Whenever there was a problem with an audit, CPA firms, the first thing their lawyers would tell them was destroy all the work papers. So if there was an actual fraud, and you say, well, why did they do that? Isn't that your documentation of what you did? Yeah, it is. But what you want to get is away from a possible charge of that you were in on the fraud, basically, to gross negligence. So the common practice, and every lawyer would tell them to do that, when there actually is fraud, when there is definite evidence that there is fraud, the first thing you do is you shred, burn, whatever, all the work papers. And they did this in the Enron case. Arthur Andersen did that. And they're looking for a gross negligence, which carries some fines, obviously, and they'll get, but it also limit some of their liability. Well, the retention rules for the PCAOB are that you must have those. If you don't, you can lose your registration, which means you're out of business. Because if you're doing publicly traded companies and you can't do publicly traded companies, you're out. So they have to keep it for at least 7 years. Their work paper retention. Um, and basically, you got to check for your state laws because a lot of times there are now state laws that are 7 years since, or 5 years is what the AICPA recommends, and they may even be more than that. So, okay, changing the working papers. AICPA, 60 days. And 60 days are what we call this is for the changing, uh, kind of cleaning up the work papers. The PCOB changed this. It was, you're probably not going to need this. It was 45 days, but now they've tightened that up to 14 days. So the new rules are that it's 14 days they have to clean up the work papers. And when they say cleaning up the work papers, it's getting those things out of the work papers. I'm gonna write something down below. When they say cleaning up the work papers, what they're talking about are getting those things out of the work papers that are really not necessary for to support the audit opinion. For instance, the scenario I gave you where someone said, "Oh, so and so is embezzling money." This is how they're doing it. And you go look into it, and there's nothing. And by the way, as an auditor, I've had that happen a couple of times. Oh, this person's doing these bad things. You go look at it, and they're like, "There's nothing there." And yeah, we did sell that. It's here's the money that came in. This is from the auction house. It was actually done at an auction. Here's the check from the auction house for $482. I didn't take it. Here it is getting deposit. You run into that kind of stuff. So a lot of times you're cleaning up stuff like that. Things that have nothing to do with the audit, it has nothing to do with your opinion. It's things that are incidental in there that you don't want to get people distracted by them, basically. So it's usually things that are not necessary to support the opinion. That's the biggest thing. And those things that are really just dead ends that don't add up to anything, kind of cleaning them up so that what you have supports the audit and there's no other stuff in there. So that is kind of what we're looking at. Now, here's the thing about work papers. That's for taking things out. Let me go back to the handout. So this is for cleaning up. Let me put something here. In other words, taking things out. Auditors can always add to. Auditors can always add to the work papers. So AICPA, you have 60 days to take things out. PCOB, you have 14 days to take things out. However, you can always add to the work papers, and you will. As something happens, as time goes on, you're auditing IBM, okay. IBM merges with somebody else, okay, or, it buys up another company, okay. You're going to put that in the work papers because when people go back to look at those work papers, you go, okay, here we go. On July 8th, way after the end of the year, they bought such and such company. That'll be in the work papers. You're going to add it in. You can always add things. You can't take things out. So they can be added, they can't be taken out. And remember, the problem was that when there was a problem, things would be taken out to the extreme. They'd get rid of all of the work papers. So you can't take anything out of the work papers after 60 days for the AICPA and 14 days now for the PCAOB. Any question on that? You can always add. You can always put things in. You just can't take anything out after 60 days and 14 days. Okay. We're going to skip this review problem because I actually changed this. I took this out. This will be in chapter 6. This will be in chapter 6. I split this. I used to do chapter 5 and 6 together. It's just too much. And while it is, you do have to find out what's material to get, to get evidence. We're not going to do it in this one in chapter 5. So skip review problem 1. Review problem 2, though, we're going to do this one. Can I just erase this? Let's erase some of this. So we are going to do review problem number 2. All right. And this is for testing for the assertions. Now, the assertions are here. I'm going to copy these down just to kind of remind us of what these assertions are. So these are all the assertions. AICPA, if they say there's a sale, did the sale really occur? If they give you the financial statements, are all the sales there? Is it complete? Authorization, accuracy, all these stuff, cutoff, is a cutoff for the end of the period correct or not? Classification, blah, blah, blah. So these are all of the assertions. Now, the ones that are probably the two that are the most tested will be completeness and existence, or occurrence, I guess, is also in there. Yeah, I'll say it. So these are the two that are probably the most tested. Do we have everything? Did it actually happen? Is everything there? And if everything is there, does everything that's there, does it actually exist? If they say there's a sale, that'd be with occurrence down here probably. Did it actually happen? If they say that they bought an asset, does it actually exist? Can we go look at this asset or verify that the asset's there? So these are kind of the ones that are the most important, and you generally see these under completeness. I'm going to take out occurrence, not to confuse the issue, just so these are probably the ones that are the most completeness, existence, and those are for both the PCAOB, obviously, and for the AICPA. So this is where you do a lot of testing. Okay, so testing of the assertions. I will guarantee you'll see this on the CPA exam. There's always something on this. Here's the flow of information. We get source documents. It could be the invoices, receiving reports, whatever. And as accountants, this is what you'll get. So let's go to the accountants, us. So the accountants will get these. And we'll make the journal entries. Journal entries will go into the general ledger. General ledger goes in the trial balance, and the trial balance goes in the financial statement. So this is the flow. We get these documents. We make the journal entries. And it goes into, goes down the line until it ends up in the financial statements. And this is what the auditors are going to audit. Yeah, we'll make the auditors turquoise. So the auditors are going to look at the financial statements. Are these materially misstated or not? So the accounts in the company, the client's accounts, will be these source of documents. Now, when we test these financial statements, so we're testing these financial statements, there's a couple things that we do when we do our testing. When we check for existence, we'll pick numbers out of the financial statements and see if they exist. Okay, they say they have a $500,000 piece of equipment. Let's see if they do. We should be able to trace it from the financial statements back through the trial balance, the general ledger, to the journal entries, and get to the source documents. So existence is going to go in kind of the backwards direction. You start with the financial statements and go back. Okay, they say their sales are X. Let's see if these sales exist. Completeness is the other side of the coin. Do they have everything in here? One way they can make themselves look more profitable is by not putting everything in there. So, for instance, like liabilities. You get a bill from the phone company. You want to make yourself look more profitable, so what's to stop you from not entering that into the system? There are ways to find those things. Liabilities are a big one that you check for the existence of. Phone bills usually aren't that big of a thing. How many phone bills do you get a year? Oh, come on, you guys have phones. I got a lousy phone. How many phone bills do you get a year? You're sleeping or doing something else. 12, right? So, one of the ways you see if they're complete, okay, where are the 12 phone bills? And making sure those 12 phone bills are all into the financial statements. So you're going to go from the source documents, the phone bills, and making sure that those are included in the financial statements. So they go in both directions. Okay, multiple choice. Tracing the source documents at a trial balance would most likely be associated with which assertion? We're going to sit in awkward silence until somebody gets it. This class could go on forever. Anyone? Okay, I tell you what, I'm just going to send out the. And let me see, I'm going to start the poll. Okay, so I sent out the poll. So I think there's only 6 multiple choice questions. Is that right? Yep. Okay. There are six multiple choice questions. I tell you, go ahead and see if you can get these. And let's say be back at let's say 7. This shouldn't take more than a few minutes probably to go through. Tell you what, so we'll say be back at we'll say be back at 7. Maybe 15 minutes, like 7:01. How about that? So we'll close the poll at 7:01. And again, there's only going to be 6 of them. So on some of these, you're going to have to um, click on the no question. So for 7 through so 7, 8, 9, 10. Just click on no question. It's not going to let you submit it, I don't think, until you do something. So 7, 8, 9, 10, just click no question. And even if you answer something in there, we're not going to, it's not going to count anyways. Okay, I'll see you guys at 7:01. Anyone else still working on this? You can put it in chat if you want. Okay, I'm going to close it. Yep, one is good. Number two. Yep, it's the last day of field work. Three. Yep. Four. Yeah, the financial statements are the client's responsibility. And five. Yep, very good. All right, well, we got all of them, so let's save that. Yeah, let's go ahead and put it up. Okay. Very good. Okay, let's go ahead and jump into the sampling overview. Okay, sampling overview. We should probably wrap up early tonight, hopefully. Sampling for variables. This is when we're talking about these, we're talking about the classical sampling and monetary unit sampling. Oops, not mud, muss. Okay, and this is stuff you guys already probably know from your stats class. And basically, it's allowance for sampling risk. This is how many dollars worth are you out, basically from the, depending on your standard deviations. Hey, this got messed up. I must have changed the, I don't know what I did. Oh, wait a minute, this got messed up. I know what happened now. You should all be 14s maybe. Okay. So basically three standard deviations. The more you go out, the more sure you want to be, the larger the span, given the same data. So, those always go hand in hand. That if you have the same data, the more you want, so you're 68% sure that it's within 95 to 105. You're 95% sure that it's in between, and you guys, I'm sure, have gone through this in your stats classes. So it's basically how sure do you want to be? So your sampling risk, this will tell you the deviations. Your sampling risk will then translate into your allowance for sampling risk. So for instance, this one, the range would be, you're 94% sure that the range is between, what was it, 100,000? So 100,000 minus 10,000. So this will be between 110,000. You're 95% sure it's between those two. You're 89% sure, actually a little bit more, that it's between 85,000 and 115. So there's always this idea, though, that it's, there's the error factor here. Given the same data, you're going to have to give up more dollars to be more sure. So you're 99% sure that it's between 85 and 115. A larger sample size will reduce the sampling risk and the allowance for sampling risk. So you can always pick a larger sample. If you don't like what you're getting, you can always get a larger sample. Okay, sampling for attributes. And we talked about this a little bit last time. Same idea. The only difference, though, is that the sampling risk, the allowance for sampling risk is going to be a percentage rather than a dollar, because you don't test for dollars for sampling for attributes. Sampling for attributes, that's like we basically use it for looking at internal controls. The purchase order is being signed, the receiving report's being signed. Yes or no. They're yes or no. They're either the attribute's there or it's not. There isn't any variable in it. It's a 0 or a 1. It's a binomial. And so unlike up here where we have our allowance for sampling risk is in dollars, down here we don't have any dollars. The percent, these are actually, I should take this out. The percentages are more likely going to be something like, 3, 5, etc. But it is going to be a percentage. It's not going to be a dollar. Okay. So just no tests. And these are simply to be, can you rely on the internal controls? So here's an internal control. If its control requires 2 managers' signatures on checks written for more than $5,000. And this is, of course, there to make sure that if you do write a large check, that at least 2 managers know about it. You don't want one manager having being able to write a very large check and not having anyone know about it. Now, they take a sample of the checks written for more than 5,000. So this is your sample. And determine whether they each have two manager signatures. Each check on the sample would be determined to either have two signatures or not. So it's either yes or no. And we got a little problem here. Okay, so the auditors choose a sample of 200 checks for more than $5,000. And their tolerable rate, error rate, is 7%. So they're okay if it's up to 7%. The allowance for sampling risk, so this is the plus or minus, basically. Let's do it differently. It's 3%. And the results are as follows. Okay, so I did these. Checks with two signatures, 196 of them had it, and checks with only one signature had four. So we're going to take our error rate for our sample is going to be, I'll do it over here, 4. Oops, yeah. 4 errors divided by 200 in our sample. So that's going to come out to 0.02 or 2%. So that's our error rate. However, we have this allowance for sampling risk, which is basically plus or minus 3. Now we know it can't be minus 3 because that would take us over 100%. And usually when you do these, you're only going to do it at the negative end of it. You're only going to do it as uh, you're not looking for a dollar amount. You're looking for can you rely on these controls? So you're basically just going to add that to your error rate. So the upper limit will be our error rate. Of 2% plus our allowance of 3%. Okay, so oops, let me add a percent onto the back of that. So the upper limit is 5%. And think about it, kind of just like we did for the dollar amounts. It's what we observed. This is our best estimate. So this is our best estimate of what it is. But this is a sample, so it could be worse because we didn't look at everything. So this is the upper limit. This is probably the most missed one on the test, on the sampling test. From the results below, we rely on the assessed, yes. We would rely on it because the upper limit is less than our tolerable. Oops. Excuse me. I'm gonna put it down here. One element, maybe one element power mode. Yeah. So we're less than 7. So we would say, okay, the controls are working, good enough for us to sign off on this. During the controls are. I'm just trying to get more room here. Okay, these are also shown on the CPA exam quite often. This is that the auditors come up with. And these are the actual amounts. Now, notice that in real life, you won't know those. So these can be generally unknown, but you want to know, okay, hopefully what the auditors come up with will be the same as the actual. And if they do, you go, okay, well, that's good, right? So if the auditors say the internal controls are adequate and we say that they're adequate, that's a match. Then our sample matched the actual. So this will come up with the correct solution, the correct conclusion. I put conclusion in, or is that going to be too much? Yeah. What if hey, it works. And same thing for the inadequate. If we say the controls are inadequate and they really are inadequate, we can't put the correct conclusion for that too. So these are the two that this is where we want to be on these two. Now, suppose that we come up with well, let's take the first one. Let's say that we come up with that where they're adequate. We'll take the first one first, adequate, when they're really inadequate. This will lead to, we think everything's okay, but they're not, it's not okay, it's wrong. Okay, so this will lead to over-reliance. So this will be over-reliance on internal controls. If we say that they're inadequate, when they really are adequate, this would be, I guess we keep it in the same one, under-reliance. You could also say incorrect rejection of internal controls or something like that. And I need more room. Now, these two scenarios are not equal. If we think that the controls are adequate and they're not, this leads to an ineffective audit. If we think that they are inadequate and actually they are good, this is a inefficient audit. And the worst one is this here. This is what you really want to avoid because you think everything is okay when it's not. This down here, you're just going to do more work. You go, okay, we can't rely on the internal controls, so we'll do a bunch more testing. And you'll come out to the right conclusion in the end. But this one, you think everything is okay and you're just happily going along, and you're having an ineffective audit. You're relying on controls that you should not be relying on. And the same thing down here, the next page, sampling for substantive procedures. These are for variables, dollar amounts. And this is probably, well, this is the more serious of these two, because this is what you're actually signing off on. And down here, everything is the same as we just did. So these are the auditors, and these are the actual. And just like we have up here, I'm going to copy them. I don't know if we can do this or not. Let's see. Yeah, I can. Now this is going to be a little bit different. If they're not materially misstated and you think they are, you're just going to do more work. Scratch that. If you think they're not materially misstated, you're going to have a material misstatement on the financial statements. You have an ineffectual audit. This one, you're going to do more work, and you'll eventually come out that they're not materially misstated because you're probably going to do a lot more work on them. And the more work that you do, the more you're going to come to the conclusion that they're not materially misstated. But you're going to think that they are materially misstated when they're not. These are and so you're going to end up doing extra work on these. You're going to think they're bad when they're not. And I'm sure the client's going to want to correct you on that. Well, you think they're materially misstated, they're not materially misstated, you're going to be doing extra work. Again, this is an inefficient. So this is again the dangerous one is right here. This is the dangerous one. I don't know. What did I do up here? I didn't do anything. So anyway, this is the dangerous place when something is materially misstated, you don't think that they are materially misstated. And you sign off on the audit and there's a material misstatement. Okay, last thing. if we have, I gotta do something here. Okay, suppose that the initial tests of the testing controls indicate the controls cannot be relied upon. What should you do? You're going to increase the substantive procedures. If you can't rely on the internal controls, you started going through the controls and they're a mess. It doesn't make any sense to keep doing it. You're not going to be able to rely on them. So what you'll do is if you can't we're going to use the internal controls to reduce your substantive, then you're just going to do more substantive procedures. So these are the dollar amounts. So for instance, let me put an example in here. So maybe your audit plan was this. So here's your audit plan you start out with. You're going to, oops. So you're going to do test the controls. You're going to do 200 and substantive or 500. You start going through these test controls and you realize you can't rely on them. What you're probably going to do is, okay, new plan. We can't rely on the controls. New audit plan. We can't rely on the controls, so let's bump up the substantive ones. Maybe we'll do, I'm just making this number up. 12, not 12,000. But maybe instead of this, instead of doing 200 and 500, you go, okay, we can't rely on the controls. So what we're going to do is just forget about the test of controls, and we're going to do more substantive testing. And we should get to the right conclusion if we do that. Because there's going to be more of the dollar amounts being tested, and that's what you're going to look at for the that's what you'll be signing off on, basically. Okay, so we can turn this one in too. Okay, so we can turn the chapter 5 in. Let me just stop this. So we can turn the chapter 5 in. We can turn in the overview of sampling, and I'll send out the exam. I'll have that out. It's actually already done. I want to take another look at it before I send it out. But they'll usually get those later on tonight. And again, it'll be due a week from Friday. So it'll be the chapter 5 evidence. All right. Good night.